Well, let's look at what are VCs doing. And we already heard a little bit about it. There's a lot of activity. Clean tech has become a mainstream segment for VC investment, with order of magnitude 25% roughly of total VC dollars invested. When you look at it over time, though, you see it's been ramping up aggressively until 2008. And I think there's a couple drivers for it. What I don't have on that chart here is the dark years of 2000, 2001, 2002, when most of the VC dollars was going into telecom and internet and web, whatever. And a lot of that capital was wiped out. So then many funds were looking for greener pastures where to find good investment opportunities, and that's when a lot of capital started going into clean tech. So you see a nice ramp up over a couple of years. And then
excuse me, Gerd. If one was to, on an annual basis or quarterly basis, it looks like the chart would end up. Is that right?
Well, this is a little bit mixed. So from 2003 until 2009, those are annual numbers. This is just Q1 2010. So if you were to break it down on quarters, there would be much more ups and downs even. This is really added up for the entire year. So obviously people got a little more cautious here on where to put the money. There's still a lot of VC money available in terms of dollars committed to VC funds, but the way VCs deploy it, I think, has changed a little bit. Now let's zoom in a little bit, and I want to say thank you to Ernst & Young. It's always difficult to get data on that. That's a set of data I got from them based on their own research. And a lot of VC investment, some of those financing rounds get announced and some don't. Companies are in stealth mode, and. So this is an analysis done by E&Y, looking at four different segments out of that clean tech cluster that we spoke about. So you see, for example, solar, that really shot up to extremely high levels in 2008. And that is when I think many people said, okay, so solar, many of the solar technologies use silicon. There's this kind of Silicon Valley that gets us a little bit closer to what we've been doing. So maybe people started feeling more and more comfortable with it. And I think that started happening around here, 06, 07 maybe. And then people realized, oh my goodness, those companies need a lot of capital. It's not just about putting in 10, 20 million to write some nice software, or maybe 50 million or so to develop a chip. Those companies need hundreds of millions. So I think part of that is because people like the space, and part of it was because the companies they had already invested in earlier rounds just needed more capital. But then I think also what happened is people realized this is not really sustainable. And why did they realize that? Well, look over here at biofuels. I think a similar thing happened a little earlier, actually, where biofuels, and a lot of that is ethanol, corn ethanol, or the first and maybe second generation biofuels. Tons of money was poured into that, and initially it was technology development, and then it was building manufacturing plants. So that ate up a lot of capital, and this is when the markets tanked, and people said, that doesn't make sense economically, what we are doing. So you see that dramatic fall here in investment. To contrast that with a positive story, so there's positive examples at least somewhere, efficiency. So efficiency, you see pretty much a constant ramp here. Again, bear in mind, this is just Q1 of 2010. So if you multiply that roughly by 4, I think we end up in a similar ballpark than previous year. So I describe that as a success story. And my interpretation on why is that the case is many of those businesses don't require that much capital. You're quicker to market. You're actually quite often selling to commercial enterprises, retail stores, stuff like that. You're not selling to the utilities with a different purchase behavior and all those things. We'll talk a little bit more about that as well. The last one here is storage. And I would say it's a little bit a mixed message here based on those data. I mean, there's ups and downs in there, but overall, I would say it's pretty much flat. There's not that much of an upswing or a downswing or something I could see in there. Which tells me that investors kind of say, that's an interesting space, but haven't fully gotten their arms around it and feel 100% comfortable. So let me talk a little bit about how we as one VC look at it. There's a question here.
Yeah, before you leave the investment, when you're talking about VC investments or financing, and you're talking strategic investments and financing, what is the outlook in terms of years? What's the payback? I know VCs are relatively short, but how long do you look at them for strategic?
It really depends on which fund you're talking to. There's a broad range. There's the early stage investors, the Series A investors. For them, I would say 5 to 7 years is perfectly acceptable. We are more an expansion stage investor. Expansion stage defined in the sense of there's product available that you can sell to the customer, which also means a good chunk of the technology risk is gone, but you still have some market risk and all the execution risk, of course. I would say 3 to 5, that's the sweet spot for us. And then there's the late stage investors who want to see an exit within 1 or 2 years. It's different time frames with different expectations, different risk profiles, different returns that they expect for that. I think one fairly hard number is when you look at the life cycle of a VC fund, it's usually 10 years from raising the fund until winding down all activities for that fund. So that means within 10 years, somehow they need to see an exit. And that can be a little painful at the end of that period. So I'm not going to go into detail on that one because David had a much nicer slide on that one. This one is just to point out what we like about storage is it's a huge market. It's billions and billions and billions of dollars. But then when we try to zoom in a little bit and get a better understanding of what it is, we find ourselves in a zoo of different solutions, whether it's electrical, mechanical, thermal, chemical. And when I say chemical, I might have a little bit of different interpretation than many of you. They really mean that we convert electrons into hydrogen or methanol, or whatever, you name it. Whereas with electrical chemical batteries, I would throw it into electrical. So it's kind of, do we store it in electrons or something different? Then there's all those conflicting requirements when you look at storage systems. We spoke a lot about power versus energy. If you want to use it in mobility applications, weight is a key factor, safety is a key factor, charge-discharge properties, we heard about that, environmental aspects, what kind of materials are you dealing with and how do you recycle, and what happens in case of an accident, all those things. Something that always gets me nervous down here, pricing power of large incumbents. There could be a startup company having a beautiful battery, which is 30% better or 50% better than an incumbent. And one of the big incumbents with billions and billions of dollars in revenue says, we're just going to wipe them out of the market by dropping our price 30%. Here goes your nice technology. So that's something we are worried about. And then the last one, there's different ways to phrase it. I just put it down here. Companies competing with countries. I mean, we see that in certain geographies, the government really made it a point. And when it comes to energy storage, maybe we need to lower our voice a little bit because I mean, we've been pouring millions and I think billions by now into that as well. So is that a level playing field? Maybe not exactly. So why I'm saying all that? Those are things that come to our mind as a VC investor when we look at a storage company. So exciting market space, but it's really difficult. So those are a bunch of bullet points here on when we see an opportunity, what do we like or what do we dislike or what do we get concerned about? So one of the first ones is evolution versus disruption. So what is that technology? Is that 5% or 10% better? And if that's the case, then we would claim either you have a strong story on how you accomplish that every year that you get better, or otherwise we feel like that's great in the short term, but in the medium term, that technology will get marginalized because someone else will come with the next 10% improvement, and then you're kind of left behind. So the more significant the step forward is, or leap forward, the better it is, provided that the technology risk is kind of acceptable. And also, always assuming that you don't violate the laws of physics, because I think they are kind of strict. The second one also is a very important point. And I phrased it technology versus capacity. I think that's where, when you remember the slides on biofuels and solar, well, things got a little confused there. The VC model, I would claim, is mostly centered around developing new technologies and bringing them to market. And that goes into overall capital requirement, that goes into holding periods and all those things. When you develop, just one second, let me finish that one thought here. When you develop a new technology and then find yourself in a position where you actually have to build manufacturing capacity to make that, whether this is ethanol plants or manufacturing solar panels at a large scale, and all of a sudden you start pouring hundreds of millions into that, that doesn't really fit the VC model anymore and also doesn't meet the return expectations. Or another example for that would be from technology to project development. We've seen that also. Even in the solar case, you could say you develop the technology, then you build a plan and make those panels, and then, okay, now I'm going to develop the projects which use my panels. So here go another couple $100 million. And that's not the VC model. Sorry, I kept you waiting there.
Oh, no, not at all. Thank you very much.